I feel it was super positive and bullish for Eigen, the token, and Eigen Layer writ large. And I wish more of the coverage had been focused on this.
The long list of announcements really overshadowed what I think is like one of the most interesting token designs we've seen to date. Maybe the most interesting for an ERC20 token.
Hey everyone, wanted to give a quick shout out to the Wormhole Foundation. If you're a Bell Curve listener, you know that transferring across chains can be a massive pain. I certainly do. I complain about it on this program all the time. That's why we are super pumped to have partnered with the Wormhole Foundation, the stewards of the Wormhole Protocol. The Wormhole Protocol connects over 30 blockchains and 6 different runtimes, including Solana, Sui, Ethereum, Layer 2s, and more. And the coolest part about this particular partnership is that they have made custom Bell Curve NFTs, which you can get and mint for free. You can claim that by just going down into the show notes and clicking on the link. All right, guys, on with the show. Hey everyone, wanted to give a quick shout out to this episode's sponsor, Flood Protocol, the optimal DEX aggregator. Now, if you are a listener of Bell Curve, you know that MEV is a massive problem, which is why we are so pumped to partner up with Flood on this season. Flood is the only gasless and MEV-free aggregator that not only gets you the best execution, but also gives you back all the extra surplus that you create every single time you swap. Now, this is relevant for both swappers and developers, but you're going to be hearing all about them later in the program. So for now, thank you, Flood, and back to the show. Hey everyone, this episode is brought to you by Uniswap, delivering the best on-chain trading experience in crypto, period, bar none. One thing I want to call out is the Uniswap extension. So say goodbye these days of these annoying sort of pop-up wallet extensions. You lose your place trading, you have to open it back up. Uniswap now has a nice, sleek sidebar that persists no matter where you are on the web. It's much easier to use. If you click the link at the bottom of this episode, you can join the waiting list. And I'll see what I can do to get you moved up that waiting list. But definitely go click the link, check it out.
All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone. Welcome back to another Bell Curve Roundup. You got me and Myles today, the homie Myles. How are we doing, buddy?
It's great to be back, my friend. Spent some time on Empire, but, had to come back home.
Yeah, I know. I saw you over there.
What was that all about?
Heart ripped out of my chest here. Yeah, but whatever. You started with the cream, and then you gotta go down and slum it with Yen over there.
Occasionally,
yeah. So I've been waiting for you to comment on my Mediterranean bronze here that I have for being in Italy. It's a little rude. You haven't said anything yet.
I was waiting for the podcast so you could get the max amount of bang for your bucks with the the compliment. But you just front ran me on it.
Oh, dude, honestly, Italy, at the risk of being not objective, it is the best country on earth. It is so freaking nice over there. They got the food, they got the culture, they got the wine, they got the coasts. Yes,
I got no notes for Italy. No notes. Nothing to complain about. It's all good over
there. It really is. It really is. So I guess in terms of, I do feel like, so I actually unplugged from Twitter, didn't check my feed at all for 6 days. And when I came back, I feel like I missed 2 years worth of news in those 6 days because I was gone for the Eigen Layer airdrop. And we'll call it a triple announcement because they actually packed 3 pieces of news into one, 2 of which are actually extremely significant. And I think we could just riff for as long as feels fun here on our Eigen Layer announcement, which is basically the big news of the week. So let's do it. So maybe to give a summary on what this triple announcement really was. So on Monday, Eigen Layer announced 3 different things. They announced the Eigen Foundation, which again is technically an announcement, but should not have been a surprise to anyone. We all assumed that Eigen Layer was going to progressively decentralized, but still they formally announced the foundation. They also announced the details of the airdrop, and they also announced this idea of Eigen as an intersubjective work token and effectively pushing this idea of dual staking between ETH and Eigen, the native token. And to be honest, I got a lot of this actually from the Blockwork Slack and the sort of combined Twitter response, but a lot of it was not super positive. And I think you and I both are of the opinion that actually, especially what they're doing on the Eigen dual staking intersubjective warp token, that is super cool and very bullish. Eigen Layer, the project, and Eigen, the token. But I think they overshadowed it by combining all of these announcements into one thing. And to be honest, not doing a super great job around communicating the details of the airdrop. So why don't we start with the details of the airdrop? That's gotten a ton of attention so far, so we don't need to spend a ton of time on that, but we should maybe focus the majority of this on the more bullish sort of good part of Eigen, the token. But can you give us a sense of why were people upset in general with this airdrop?
Yeah, I think so. Maybe just running through like reasons off the top of my head why people might be upset about the airdrop. So they're going to airdrop a total of 15% of supply, which is actually quite a lot. Now this first round was only, I think, 5%. I could be wrong on that. But I think, maybe the amount was a little bit less for some people if they deposited later, right? And so it was a function of both how much you deposited and the time it's been in the protocol. But I don't think people should really be complaining. It's, I based off of where Eigen is trading pre-market, it's about $1 billion airdrop. And it will just, it'll be well over like $2 billion if they, once you get to the full 15%. So why are people upset? I think the whole, it being, claimable on May 7th, but not transferable, meaning like you cannot sell your airdrop they have not announced any sort of timeline on when it becomes liquid. But, I think this is something we'll see more and more. The current like legal meta is that you need to do this, or lawyers are, strongly advising projects to do this for regulatory reasons. And so not much you can really do about that. And I think we'll get to like the staking component and what the token does later. But I think there's also a rationale that you could make here that, Eigen Layer wants to encourage folks to stake this, right? Because it's going to be a critical part of the Eigen Layer, trust and security marketplace. And so if you can't sell it, people are more likely to stake it, especially if you then, maybe in the future release some information around ongoing incentives for staking your Eigen, right? And then the last one, I think it was the geo-fencing, right? And so it was, I don't really have benchmarks, but it seemed like a long list of countries, even compared to most airdrops today. And I think what pissed people off was that they didn't geo-fence deposits. They let you put in your TVL, let you see your points accumulate. And then, it's not like those folks, if they were to go to one of the approved countries, couldn't claim their airdrop, but it's just very challenging to do in one of the geo-fenced countries, right? And so, I'll pause there. I think, some of this stuff is just the regulatory environment. It's really challenging. I don't think Eigen Layer ever, want it. Like it wasn't their actual like desire to do this. But it's just the dynamics of the regulatory environment.
So let's focus on that last point, the geo-fencing.
Sure.
So I just said I got back, didn't check Twitter for 6 days, opened up my timeline and just saw a bunch of people whining about the Eigen Layer drop. And I just tweeted, nothing upsets crypto people more than being given free money the wrong way. And oh my gosh, I didn't know any of the details when I tweeted this, but I just got bodied. People were super upset. And they made a couple of good points. So one, there's this idea, it's not really free money, is it? Right? You're locking up capital in a smart contract. There is risk there. You're taking on risk and you're getting compensated for that. So it's not free, and that's totally legitimate. And then it really was around the not being geo-fence for depositing, but being geo-fence for withdrawing. And there was an additional nuance, which Ceteris Paribus over at Masari pointed out, which is that they actually, not only did they allow people to deposit, but they incentivized you to deposit with points. And honestly, I pushed back a little bit, but I ended up agreeing with him that it does feel a little bit from the perspective of a user, like, if you're going to incentivize me with points and then not tell me that you're going to block me, that does feel a little bit like a broken promise, and I understand that. Here's something that I got a question for you on this. So in terms of the risk that you are taking locking up capital in Eigen Layer, how much risk are you really taking, honestly? Like, I think the pros and cons, right, of locking up capital with an extremely well-funded, blue chip, frankly, Western-based project is, like, you're going to be subject to the regulatory and geo-fencing stuff. You just are. And if we're treating people like adults, I'm sorry, there's a little bit of like, you guys should have been aware of this. Right? Like, this should have occurred to you that this was going to be the case, that Eigen Layer wasn't just going to throw caution to the winds, ignore the regulators, and and so, people are also complaining about the amount that they got airdropped. And it's like, well, the amount that you get airdropped should probably be consummate to the risk that you're taking. And there's a massive difference in my mind of locking up capital in an Eigen Layer smart contract, which is probably audited by,
Yep.
Gigabrain, team of devs, smart contract auditors, all this stuff. And they would probably compensate you anyway if there was some big problem with some $10 million DeFi protocol on a new L1. Like, the compensation should be different.
Yeah. Yeah, I agree. I think, a lot of the deposits were speculative in nature. A lot of the deposits were not, putting their ETH into Eigen Layer because they want to hold it in there for the next, 5 to 10 years and just have, a nice 3 to 4% of extra yield, or whatever percent of extra yield it was. It was really around expectations for this airdrop. And so, any sort of speculative activity can go one way or the other.
Yeah.
And so that's kind of like, I don't have a ton of sympathy in that sense, but, I think there's not a lot to say on the geo-fencing part. And what is the risk? Like, it's probably, we saw like Blast was a multi-sig, right? I don't think Eigen Layer was a multi-sig, but it may have had multi-sig governance for a bit. Both of them, is you're putting some level of trust in the team and in the developers. And I don't think it'd be one thing if, there was, you had deposited into Eigen Layer, restaking to AVSs was live for a long time with slashing, right? So maybe you're taking on slashing and smart contract risk, and now you're feeling like, this is really unfair. But no, I don't think like the risks were that crazy.
Yeah. Okay, Myles, what do you think about, the other thing that people tend to complain about a little bit is the amount of, first of all, this isn't an airdrop, it's a stake drop.
Okay.
But the amount that is getting stake dropped to the community, 15%. And you and I have had this discussion before around airdrops. There's, to broadly overgeneralize, I feel like most people fall somewhere in the middle around this, but there are two camps. There's the airdrop entitlement camp, which is, I want to just basically get airdrop the value of a free car and then withdraw my assets, and that's probably not worth it. And then there's the camp, which is these people are taking an enormous amount of risk, locking up capital in a smart contract. They're bootstrapping so that the project can get a high valuation and attention from VCs and all that stuff. And again, the truth probably is somewhere in the middle of those two things. But, people around the Eigen Layer airdrop specifically, what do you think about the 15%? And this is maybe the backdrop of this is that last week, Renzo, which is one of the new LRTs, they did their airdrop, and they allocated 2.5% of the supply to the community, but they did a pie chart where they just resized the 2.5% to look like 25%, which was not super great. And then they ended up walking it back and introducing more supply to the community. But where do you fall? Because this is what always happens is, well, maybe you should be giving more or less. Whatever.
Sure. I just maybe like take a step back. What are the potential objectives of an airdrop? And you can hit multiple of them, and ideally you want to. Way I look at it is, one, rewarding those early adopters who took on a lot of risk to bootstrap, liquidity in your protocol, or bootstrap whatever you are trying to incentivize, right? Two is potentially reaching new users, right? So airdropping to non-users that in the hopes that they come, either become a user or maybe even a developer like comes and starts contributing, right? And then I think there's 3, you can use an airdrop to incentivize future action that you want or future behaviors that you want, meaning make it partially claimable, right? And the full claim is based off of continuing to use the protocol in a way that protocol is trying to push users to do. For this one, maybe it's staking your B Eigen. You'll get another phase of this airdrop. That's just total speculation, but that's one way to do it. Then there's the last one is just this like kind of fuzzy idea of getting your token distributed as widely as possible to a very large user base, right? And there might be benefits to this around wider decentralization of governance participants. Maybe it's for some reason you want lots and lots of different Eigen stakers and Eigen holders so that it's not ultra concentrated, right? If like Eigen staking is going to be core to the protocol and it's the holdings are really concentrated, that poses a risk that at any point one of these very large holders could just pull out. So yeah, I think those are the kind of like broad objectives, and I think there was components of all of this with this Eigen Layer airdrop, and I think again like 15%, it also really matters. That percentage matters a lot based off of what the market cap of your token is, right? 15% is above industry benchmarks broadly, and the market cap is well, what maybe one of the largest projects to launch in a very long time, right? And so from an amount standpoint, I think I'd be very curious to see just how like the distribution looks and how concentrated it is to like the whale depositors versus some of the smaller depositors. But yeah, I think they are rewarding early adopters sufficiently. I'm very curious to see like if future unlocks of even more airdrop is contingent upon staking it or something like that, right? And yeah, I don't know about the distribution piece here, but I'll pause.
Okay, I've got some thoughts here, and so totally agree with all the possible objectives of an airdrop. One additional bit of context that I would add is I think that has changed. The emphasis on what airdrops are trying to do has changed over time. I think if you listen to, I think Kane was the original, or it wasn't airdrops, but yield farming. And if you listen to guys like Kane and Rob Leshner in the beginning talk about how they thought of it, I think there was a lot of sort of like Bitcoin and Ethereum protocol design thinking there. And if you listen to what they were trying to do, yes, they were trying to bootstrap liquidity and attract new depositors, etc. Yeah. But really, they did believe in this idea of trying to get the tokens out into the hands of as many people as possible. And similar to the design philosophy of Bitcoin and Ethereum, make it this very flat, unopinionated protocol that people would build on top of. And I think what has happened, at least on the app layer, is that largely people don't try to do that anymore. They said, you know what, that actually wasn't a very smart idea. You can look at like Yearn and Sushi as examples of taking that way to the extreme and basically distributing all your tokens. Then you're like, oh, I actually can't fund myself. So, this, and by the way, being subject to 10,000 degens on the internet is not the correct way or governance structure to build an app. And so a lot of the modern airdrops that are happening are much more focused on the first couple of reasons that you were saying: acquiring new users, incentivizing an action, rewarding first users, etc. And so the amount and the, especially because a lot of these are app-like, and you start to think of these as more equity tokens, you want to distribute a smaller amount because you want, rightly, in an equity-like thing, you want it to be going to the team and the builders, etc. Yeah. And you're not really trying to distribute that much of the supply. I think on something like an L1, there still is an imperative to the value of an L1 is that it is extremely distributed, and you don't actually want there to be a ton of the supply in the hands of a couple big investors or team members. And you can look at newer L1s as an example of, maybe the new L1s, if you wanted to do pros and cons versus Ethereum and Bitcoin, The pros is that they have the second mover advantage. There's new tech that's enabled. You can learn from the mistakes a lot of the early L1s made. But the con and the tricky thing is that investors own a bunch of the new L1s, and the supply schedule and the unlocks are going to be a bitch, and they're going to have to work through that. So Eigen, and maybe this is where we can start to transition a little bit into the Eigen token and this rebranding as an intersubjective work token and Eigen dual staking. Eigen now, by making Eigen this sort of taking some of what ETH was originally doing and actually making it this slashable token, it actually looks a little bit more L1-like than app equity-like. And I think that you could make a really strong opinion that if Eigen is going to be this intersubjective work token, then you want it, similarly to an L1, you want it into the hands of as many people as possible, and you want it to be less subject to these big investor and team member unlocks. And so, honestly, I'm usually a fan of limiting, not just giving the community a bunch of the airdrop that they're just going to dump later. But I think you could have made a pretty compelling argument in this case that Eigen Layer should have dropped more.
Oh,
what do you
interesting. Yes and no. I honestly am not totally sure. Because what really matters is that, first of all, like AVSs adopt Eigen as a staking token, right?
That's a good point.
And I think you want, to be fair, to defend like why, maybe an investor having all like big investor holders here is good, is because if there's lots and lots of this, Eigen token that is, locked up in investor investing contracts and going to be staked, that makes the amount of Eigen available for security higher, right? And so I agree with you to a certain extent. I also think that, it's kind of pros and cons of having these investors, large investor hold like bases for L1s, is that you end up with very large staking ratios. Like Solana has 60-something% staked. Most Cosmos,
I think it's even higher.
Yeah, most Cosmos,
it's like 70.
Yeah, most Cosmos chains are well above 50%, right? Because these are long-term holders, and you don't really want, like, if Eigen, if you're the Eigen the protocol, you want as many people to stake as possible, and you don't want that number going way up and way down all the time, because it's in the hands of people that are actively trading it or don't necessarily plan on holding it for the long term. So, but at the same time, I agree with you. You don't want that concentration risk that I mentioned in the first part, as well, right? It would not be good if, like, when Eigen Layer finally vests, all of a sudden, 20 or 30% of like Eigen, the security system, is gone because those investors finally like unstake and sell. And so it's a nice balance. It's a balance, right? And I think the other piece I would mention is with any airdrop, it's also a question of opportunity cost. It's, what could this 15% be going towards instead of an airdrop? And how important are those, ongoing incentives that you will eventually implement? And for Eigen's case, I would argue that they will need, heavy, like, ongoing incentives in order to kind of bridge this gap of enormous amounts of deposits to the realistic amount of real yield that, 30 to 50 AVSs are going to generate a year from now, right? And so I would say, like, if you, like, blow your whole wad on the airdrop and then you're left with like a pretty small incentive pool, that could actually really hurt like adoption of the platform, because there's not enough of the supply to really help AVSs like keep those stakers and operators on board in the early days before we hit like exit velocity on the real rewards.
Yeah. I think it might be interesting. You've actually convinced me. I take it back. I agree with you. It is interesting to compare the Eigen airdrop to, by the way, this is something that investors have been arguing about for a long, long time. I don't know if you remember, like, Bill Gurley going on podcasts a couple of years ago, bemoaning the traditional IPO process, talking about direct listings. And, if you talk to traditional investment bankers, they describe this kind of like nice aesthetic pop. Like they're trying to price the ICO such that like underprice it just a little bit so that it pops on the first day and it's this nice marketing event. And the Bill Gurley argument says, how much are you paying for that initial pop, right? Because the way that an IPO works is you sell at an initial share price. That's the cash that goes into your bank. And, you know, if it pops on the first day, you could be looking at 5 to 7% that you could have sold more. That could be in your bank account that you could be doing things with.
Yeah.
And so people argue about this because, you know, on the one hand, it's like, man, that's a really expensive marketing campaign that we're running here. On the other hand, if you have a bad IPO day, it doesn't matter, but like it does kind of stay on you. It's a little bit of a stench that you gotta work off. This is the first impression that people have of you in the markets. So I don't know. I don't have a super strong opinion on it. It's just it's a challenge. But I agree that you don't want to blow your whole wad in one shot. And also it's just kind of a human psychological thing. When you give someone something for free, they don't value it as much as opposed to kind of making them work for it.
I agree with that. It's funny. I didn't think about the whole like non-claimable aspect here, but yeah, maybe equity IPOs should also do a stake drop where it's not non-transferable, right? Because there is something to be said, like when it's claimable on day one and tradable on day one, and it's just down only.
Oh yeah,
it doesn't really help with the kind of makes the party a little bit less fun, right? Kind of dampens the mood a bit. But
well, we have so in traditional markets, there's something called a green shoe option, which is a provision in IPO underwriting that grants the underwriter the right to sell more shares than originally planned. So basically, the investment bank that wins the mandate. Usually, there are many different investment banks that are involved in an IPO mandate, but they have this option to basically prop up the stock if it's trading lower on day one. I guess the crypto version of that is whatever the agreement that the token issuer has with market makers, which has always been a little bit of a black box for me. Depending on who you listen to, it's totally above board, or it's basically a thinly veiled pump and dump, where MMs are granted free options in the token. So yeah, I think it is actually there's an important psychological impact to whether the token goes up or down, but they have other levers for making that happen.
They do. They do.
Yeah.
But yeah, I think it'll be very interesting to kind of like just see the supply dynamics of Eigen once it finally does go live, and how much stays staked, and what the the incentives are to do so.
Hey everyone, wanted to give a quick shout out to the title sponsor of this season of Bell Curve, the Wormhole Foundation. Now, if you are an on-chain user, which I bet you are, if you're listening to Bell Curve, you know that the cross-chain experience in crypto still sucks. Let's just call a spade a spade. We talk about it on this program all the time. Interop is still a big problem, which is why we specifically wanted to team up with the Wormhole Foundation. They are a decentralized interop platform that powers multi-chain applications and bridges. So that could be anything from DeFi to NFTs, governance, oracles, and more. So if you are a developer and you're building cross-chain assets, apps, or data, or anything like that, I highly recommend that you click the link at the bottom of this episode and go check out to see what you can build on Wormhole. And Wormhole, first of all, this is a fun team. They did something really cool with us. You can actually go and click the link at the bottom of the screen, which is going to send you to a landing page where you can claim your own unique Wormhole NFT. So we're doing this with me, and we're doing this with Jason, my co-founder. So help a brother out. It's a super cool NFT, I promise. Go click the link at the bottom of this episode and fill out your POAP, get your free NFT. And if you're a dev, head over to Wormhole and check out to see what cool cross-chain stuff you can build. Hey everyone, want to give a quick shout out to this episode's sponsor, Flood Protocol, the optimal DEX aggregator. Now, Flood is the perfect partner for this episode on the multi-chain future because Flood is solving so many of the issues that we're going to be talking about this season. And this is relevant for both traders and devs. So if you are a trader, you should definitely head over to FloodSwap and start trading because they solve 3 massive problems. 1, gasless trading. No more pesky trading fees. 2, you don't have to worry about getting front run. MEV free. And then 3, they have excellent order routing so that you know that you are getting the best price. So head over to FloodSwap and click the link in the bottom of the show notes. We're going to send you right there. For the devs out there, you can leverage Flood's flexible hooks, allowing you to make swapping a first-class primitive by adding custom order types like TWAPs. Or if you're a wallet builder or something like that, you can actually build your own order flow auction in and start recapturing a bunch of that MEV. If you want to reach out to them, go to devs@flood.bid or just jump right in the Discord. All right, guys, thanks very much. Appreciate you, Flood. Hey, everyone. This episode is brought to you by Uniswap, delivering the best on-chain trading experience, period, bar none, in all of crypto. Here's how I would divide the protocol today. There's a web part, a mobile part, and an extension part. You can say goodbye to the pop-up wallet extension. It's just not great from a UX perspective. Now what they've delivered is this nice, clean sidebar where you can just very easily track swaps, sign transactions, send or receive crypto anywhere. Just a huge UX improvement. On the web part of it, huge improvements here. You can buy and sell 700 plus tokens at your price on your terms. And they've got limit orders, which are powered by Uniswap X. And there's gasless. They've also got real-time charts, transaction logs, pool data, project information, all this cool stuff that just really improves your UX trading on the web. And again, all of this is powered by the smartest protocol in terms of Uniswap or Uniswap X. Click the link at the bottom. Uniswap extension is in alpha right now, and we'll see what you can do about getting you moved up that list. Thank you very much, Uniswap. Let's talk a little bit about the second part of this announcement, which again, just largely went under the radar, but I feel it was super positive and bullish for Eigen, the token, and Eigen Layer writ large. And I wish more of the coverage had been focused on this. So
yeah, right. It's like there's so much packed into this day, and I think there was, pieces of news that were very easy to predict. Like, we're not going to leave people thrilled, right? And unfortunately, those parts of the announcement of the long list of announcements really overshadowed what I think is like one of the most interesting token designs we've seen to date. Maybe the most interesting for an ERC20 token, that goes so far beyond, just the typical governance token, and really also solves like big problems for the protocol with this design. And so, yeah, I think we can. There might have been, in hindsight, maybe like if I were in their shoes, or like we were talking about this before we started recording, maybe you space these things out a little bit more, right? You get people really excited about the token, the purpose of the token, and Eigen staking with the white paper and the blog post and the threads, right? And then you kind of prepare people for maybe the less great news around like claimability and geo-fencing and stuff like that with like an announcement, and then you finally release like the claims. But it's okay.
Well, so just one more final note on the geo-fencing stuff. So there's a great, I would recommend people go read this post about this from Jake Travinsky. There's a lot of armchair lawyers here that really don't know what they're talking about. Jake Travinsky is a guy who absolutely does know what he's talking about. And he describes in detail that so the extremely complicated and frankly like risky, kind of scary regulatory environment that these protocols are facing, and why non-transferability and geofencing are super important. So I just recommend that people do that. But the other thing that at least I have come into contact with around whenever legality becomes a thing, sometimes it produces these weird results where, all right, let me give you like an example. So there's a really unfortunate way that the legal system works around HR sort of complaints are, if you are like, if there's a situation where you need to, an employee has to be let go or something like that, you, by saying that you're sorry, like, hey, this isn't working out, I'm sorry.
Oh, yeah.
You are admitting that you are at fault here, and then that can be turned and used against you if that person were to turn around and sue. So the legal system in some cases forces these really weird, inhumane interactions with people. And I don't know if this is the case, but maybe it would not shock me at all if people are like, well, why didn't Eigen Layer say that they were going to geofence? The lawyers might have said, hey, if you indicate that you're geofencing, it's a tacit admission that you should be worried that it's a security, blah, blah, blah. I don't know that that's the case. It just wouldn't shock me. So sorry, I wanted to...
No, it's such a good example, like an analogy to bring up, because sometimes it just kicks, legal stuff kicks like common sense and logic to the wind. And it's just, it's really frustrating. But that's where we are. That's okay.
So Myles, let's get into it here. This is the really exciting second part of this announcement, which is positioning Eigen as, I keep using this jargon, an intersubjective work token. So can you give the audience a sense of what does that phrase mean? Why are we talking about this idea of intersubjectivity? And then what is the role of Eigen the token going to be within the Eigen Layer mechanism and apparatus?
Yeah. Okay, great. So let's break that up. Let's start with what is a work token. We all know like work tokens, that's one way to call an L1 staking token or any sort of staking token, right? You are staking capital to do work, and in return, the capital collateralizes the work you do. And if you do good work, you get rewarded. If you do bad work, you lose that capital, right? Or you lose a portion of that capital from slashing. Now, before we get to like intersubjective work tokens, I think we should first lay out really what are work tokens today, and what are the limitations of them. And so there's this concept of objective and attributable and versus intersubjective and attributable. And the limitations with work tokens today are that they are objective and approved and attributable only. What that really just means is that they can only secure work that is, provable on chain, and they can only slash when it is provable on chain. Everybody can see from local information that you double signed a block header, right? Or everybody can see that you didn't follow the rules of the chain locally, that everybody has agreed upon, right? And now where this becomes tricky is that a lot of EigenLayer AVSs, the type of work that they are doing is not, if it's done incorrectly, it's not provable on chain. And sometimes it's, the problem is this work is taking place on a different chain, right? Whether it's a restaking secured L1, or maybe it's just this, committee of operators, right? And so it's very hard to prove things on Ethereum that, something was done on an AVS that was malicious. And sometimes it's even impossible on that AVS to prove on chain that it was malicious. An example of this, easy example of this is just incorrect price feeds, right? So an Oracle provides price feeds. There's nothing on chain that can tell you that, giving a price of Bitcoin as like $1 when it should be $70,000 is incorrect, right? But two humans observing the system, can clear it's not contentious at all, right? That it's incorrect, and so that's intersubjective. There's another category of like subjective, which is was this good or bad? Like is Italy better than France? And that is
it is correct. That's not subjective at all.
Yeah, right. Like that's not. Yeah, that's out of scope. That's not good for work tokens, period. But the problem is, again, it's really hard to construct slashing agreements for this category of intersubjective and attributable faults. So that is things that cannot be proven on chain. And we have, 16, whatever it is, $1 billion worth of restaked ETH, right? And we do not want to be, putting that restaked ETH at, risk of slashing with things that are completely, decided basically and socially, right? Like off chain and governance. And so what do? They have basically, all AVSs have a type of really easy types of slashing to handle, which is everything that is objective and attributable. And they have other types of slashing that is really messy. And this is this intersubjective category of slashing. I think this whole concept of, overloading Ethereum social consensus happens when, let's say the $16 billion of ETH is securing an AVS, right? And the majority of operators collude or something like that. It's not provable on chain, and it is intersubjective. And then we end up having to fork Ethereum to really roll back this chain. So what do? They introduce a second staking token that is basically meant to handle all of the messy kinds of slashing, and that is Eigen. And so AVSs, I think what they're saying, should have, two types of work tokens securing them. They should have ETH securing them, or any sort of, non-Eigen token securing them for things that are objective and attributable, so things that are proven on chain. And they should have Eigen securing basically any work that is, intersubjective, not being able to be needs governance basically to arbitrate slashing, right? And so that's what Eigen is. And so we've had like intersubjective work tokens before. They reference Augur as one of the original types. But there were a couple of issues with that previous iteration of intersubjective slashing token. One being that it is very special purpose. So it was just built for, like, the arbitration process was just built for prediction markets. Yeah, I got thumbs up bubble. I hate those things, by the way. I don't.
They bring me joy. I think it's super funny. Every once in a while in our Zoom, someone will give like the thumbs up, or like the balloons will fall from the ceiling.
Yeah, exactly.
Yeah.
It's a very serious conversation. I just have balloons all over my head. Yeah. Anyways, okay. And so anyway, so yeah, previous iterations with special purpose. And the other problem is that when there is, a slashing event, right, that's intersubjective, it's handled via a fork. So the token forks. Now that's, all good in a world without DeFi. But now that's really challenging when you have two different versions of these tokens, right? And one should, have no market value, but that means everybody who has that token, not in the staking contract in DeFi has to be able to follow the correct fork. And it's just not practical, and nobody's pursued it before because of the challenges there. And so Eigen breaks these trade-offs by creating this, purpose-built token that is meant to handle intersubjective and attributable, types of slashing events. And so the trade-offs they've broken is that this is now, a universal token. So Eigen can be used for any different AVS. And they do this because, what's built into the Eigen contracts is that you can set up rules, as you're setting up the AVS, right? So instead of everything following one special purpose set of rules, you can make, this is more modular, where you can have each AVS have its own, set of pre-agreed upon rules and laws, right? So that when there is a slashing event, it's not contentious. Everybody who is observing, and knows the rules, right, because they're preset, can follow them and follow the right fork, right? So I'll pause there, but definitely have some more comments to kind of unpack.
So, all right, there's a lot there, and I think there's kind of like the value of a work token, and then there's also this objective versus intersubjective sort of slashing conditions. And to give you an idea, I think you and I were talking about this old example from August of last year in Cosmos, which ended up, it's something called Prop 818, and it was this very contentious vote that got done. This was in the early days of replicated security over on Cosmos, where two validators double signed. So in a sense, this is a bad example because this is actually a really objective slashing condition. But listening to the drama play out of whether or not these validators should actually be slashed could tell you a little something about how contentious anything that isn't pure, even this case was interesting because it was actually purely objective, like how much human drama these sorts of events can actually create, because this is people's money on the line, right? And
totally.
And I think in the Cosmos example, I think that these validators actually get tombstoned, so they just get booted out and they can't come back. So there was more than just whatever the slashing conditions were. Yeah, there was like much greater.
Yeah, and to me that points to the huge importance of like setting pre-agreed upon processes and rules, before these things launch slashing, right? And in that case, it was, even the fact that governance had to actively do the slashing is probably not ideal, right? If it's objective, then it's on chain. then it should just follow a set of smart contracts or that process happens automatically. If it's something really messy, then you should have agreed upon the rules beforehand and make the decision that has to go through governance as, non-contentious as possible, right? It's, hey, here are the rules. They broke them. Vote yes. If you are, following the rules that you also agreed to follow, right? So that to me is like the importance of setting, I think, all of this up well in advance. And, especially with having like, two sets of slashing rules, or if you have two types of like work tokens and that map to different types of slashing, making that all very clear and making, the latter, the messy kind of like able to be AVS specific, right? Because AVSs will have their own rules.
So getting to the other part of this, which is just this idea of work tokens, I agree with you. This is just such an interesting innovation. You got to hand it to Eigen Layer. They are category creators. They came up with the whole concept of restaking. And I think this is, people talk a lot about tokenomics, but I think this is probably the first genuinely innovative tokenomic, like token design that I've seen in quite some time. And if you think about the value of Ether being, okay, people view it as a money, but the reason why you actually want to hold it is you need it to participate in validating the Ethereum network, and you can do things like stake it and get rewards, etc. This is positioning Eigen the token within the Eigen Layer restaking ecosystem as something very similar. It's a work token, and there's a reason to hold it outside of like a more traditional equity app token like thing where you're getting a stream of cash flows. Like it actually belongs within the protocol, and it's not jammed in there or it's actually done in such a way that it solves a real problem.
Yep.
I think the Ethereum, there needs to be a better word than Ethereum deed state, but like the Ethereum sort of core devs, Ethereum Foundation is going to like this a lot, because there was always a concern around Eigen Layer overloading Ethereum's consensus. This removes an enormous portion of those risks, and I think it's going to accrue a lot of value to Eigen the token. So
yeah, let's maybe unpack exactly what that means though. Like, so by showing like the worst case scenario without this Eigen token staking design versus, what a worst case scenario would look like with it. Right. And so let's imagine there's, a huge AVS like Eigen DA, and Eigen DA has, hundreds of rollups that it's supporting. For Eigen DA, the intersubjective type of slashing is data withholding, meaning so these Eigen DA operators download the data. They have a system called proof of custody, which is objective and attributable. So if the operator doesn't download the data, we have the way to prove that and slash them with like anything. All the data is on chain. You can actually see that, right? But there's this second concept of, what if they downloaded the data, they passed the proof of custody test, but then they withhold the data. They don't make it available, right? Not making data available is not something that you can prove on chain, right? So that's the intersubjective type of slashing here. And without this Eigen, without this dual staking sort of system where Eigen can handle the intersubjective type, the data withholding, what would end up happening is, let's say the majority of Eigen DA validators collude. And so they, are doing something where it looks like the majority is all doing it, which usually means it's correct and honest. But in this case, it's a, dishonest majority. They withhold a bunch of data. Let's say the sequencer operators that are in cahoots with the DA operators are able to basically steal a bunch of user funds. And now without Eigen here, the only way to punish these operators and to, basically recover these funds is to fork Ethereum itself. Like, this is the example of what people are worried about when they say overloading Ethereum's consensus, meaning that, the slashing, is not provable on chain. And so you have to do it through some sort of like social consensus or governance. And without Eigen, that fallback is Ethereum itself. Right. And so that's when all the, the folks that warned us about the risks of Eigen come out and say, like, this is what we told you. It's, overloading Ethereum's consensus. No good. Right. Bad outcome. Now let's take that same scenario, like with this dual staking design. right? So in this dual staking design, you would have basically the proof of custody, so the storing and the downloading storing part, basically secured by restaked ETH, and you would have data withholding, secured by restaked Eigen. Now the same scenario occurs. You can actually punish these actors, even if it's the majority that colluded, by basically submitting a challenge that says, hey guys, we agreed upon this, preset rule that they had to not only store and download, but they had to make the data available, right? We can all see, right, with our human eye that they did not make the data available. We're going to fork Eigen, or we're going to fork B Eigen, and those that, we're going to vote on it. Okay, great. So now we have a new version of Eigen that is the canonical Eigen. The dishonest validators are punished because this new fork basically burns all the tokens that were staked to them. And so we don't have to actually fork, Ethereum through social consensus in order to punish the dishonest validators. We can punish them, at the more of like the app layer, right? With this ERC20 token that was staked to them.
Yeah.
So in that case, yeah, EF is happy. You didn't overload Ethereum social consensus. You kind of, kicked all that, the messy slashing stuff to Eigen token. And that's good because it satisfies basically, both types of faults. And then beforehand, you would, could not actually punish, those bad actors without forking Ethereum.
So there's a lot to unpack there, and I think all right, so let's talk about this within the context of Eigen the token. Is this a good thing or a bad thing, or a bullish or bearish the token, I suppose? You could make a case that it would be bearish the token because, what's the phrase? You're making it first risk capital, right? You are essentially securing you're underwriting any risks within this sort of rehypothecation system. And you're saying that, look, I'm going to position our network equity token as the first risk capital, which, to be honest, is what like Aave and some of the other DeFi protocols do as well. It's what banks do, and that's kind of risky. Eventually, over a long enough period of time, bad things happen. You end up burning through some equity value, and then people apply a little bit of a discount there.
Sure.
Okay, so maybe that's not great. I do think, though, I'm just going to say I don't really agree with that take because I think, first of all, the risk of slashing does not happen very often. And to be honest, especially as soon as you get into this realm of intersubjectivity, no one's really incentivized for it to happen. Even there's a huge difference between forking Ethereum versus forking Eigen Layer, but even the hurdle rate for approving a vote to fork Eigen Layer is extremely high. I think these slashing events are not going to happen very much at all. And so I think you're positioning Eigen as this extremely useful token, and I think there's probably much less risk than there would be in the case of like a bank or something like that defaulting on its portfolio of loans. There also is an emerging school of thought that actually slashing, maybe we don't need slashing really at all. This is a quote from Togrel over at Scroll. The more time passes, the more I start to agree with Kevin Seknicki from Ava Labs that slashing is not necessary for protocol security. And I've heard this take around before. This was 6 months ago. People were debating, should there even be slashing on Eigen Layer ever? And I was always in the camp that you need slashing. But, one thing I've been thinking about is that in Bitcoin, there's really no concept of slashing, and that actually works. I know, don't at me. I know proof of work and proof of stake are very different, but it actually kind of works fine. And so, I don't know. I've been more in the camp that maybe slashing it is a little bit of an overrated concept in general. And I think it's just very bullish. Yeah. I think that's not a significant risk. And it just, the benefits that you get from making Eigen necessary to hold and valuable outweigh the risks of slashing.
Cool. Yeah, I agree. Maybe just to address like the slashing, like, is it useful or not piece first, and then I can give you like my overall thoughts on the token. So I would say not having slashing with proof of stake, it still does make the cost of attack higher, right? if you have proof of stake without slashing and you're able to, even if you bring in a bunch of restaked, security without slashing, that still makes the cost of attack higher. It's not nothing, right? And so, yeah, like I've been very involved in the development of mesh security, and we're going to do a similar rollout of mesh security without slashing than mesh security with like some slashing, because there are benefits to just increasing that, economic security number to a very high number, to a very high value, makes it harder to actually attack the chain. The second piece is, if you were to, my biggest, qualm with slashing is that it's typically the operators that would be doing anything malicious, and it's not their capital, right, that's getting slashed. So you're slashing these like everyday stakers because they selected the wrong operator. The operator is, basically getting their reputation slashed. But let's just put that aside for a second, because I do think these systems are more secure with slashing. It's just a question of like, can you basically get most of those benefits without it? Now, like, to my overall thoughts on like the token, I think this is overall, like, I totally get the first risk capital. Like, I think it's a bit skeuomorphic, and I don't think it's a, I think you could argue that, every L1 token is first risk capital in that sense, and we're not bearish on them. So why I really love this, because I think everybody was looking at slashing coming. And again, the really messy slashing types, the AVS specific slashing types, are pretty scary, at least on the surface. And by kind of kicking all of the messy slashing types to Eigen, that keeps the cost of capital for restaked ETH really low indefinitely, right? It's saying the only way that the only risk you're taking on is double signing and like incorrect execution, maybe. And those things you can mitigate those things with lots of different tools. Like, Cubus is a great product that has like the anti-slasher, which protects against double signing. And that is because my worry was that when slashing is implemented, there would be very big outflows, because people that were there who are okay with the risks of depositing without slashing, maybe they're not okay with the risks of depositing with slashing, right?
Yeah.
And now you're limiting the surface area of what can be slashed with that huge number of TVL, right? And kicking that over to Eigen. And that's okay. Like, that keeps the cost of capital of that original TVL really, really low.
I've got a question for you on that, though. So let's put ourselves in the shoes of an AVS that's procuring security here now. Initially, everyone was just doing it in ETH terms. Now they're going to have to make this extra decision. How much do I want in ETH-denominated security, and how much do I want in Eigen? If the idea is that, and how is it going to work in between, okay, ETH is lower cost of capital, so maybe cheaper to acquire, or like you can buy in bulk type thing.
Yeah,
but then
people already own it.
Right, people already own it. But you're not actually insuring yourself from some of the riskier, intersubjective challenges that you actually could have. So how do you balance, what is the mix going to look like ultimately of Eigen-denominated security versus ETH-denominated security?
It's a great question.
Versus also the native token, which is originally when we were talking about dual restaking.
Yeah,
there was going to be some amount of their own token,
the native token, right?
Secure. Yeah.
The short answer is we don't know. I think in terms of the cost, it will probably be, ETH is the cheapest because it's the most abundant and there's the least amount of like slashing risks around it. Eigen is probably going to be the second cheapest because everybody, like, Eigen is going to be a much larger market cap than, all of these AVS tokens, right? And anybody in the Eigen Layer ecosystem who is, already staked ETH is going to own some Eigen, right? And they're going to restake that too. Now, are projects, because projects haven't really been, doesn't seem like they're being very precise, right? With the amount of like restaked ETH that they want. It's just kind of like, let's get a big number. I don't know how precise they're going to be with the amount of restaked Eigen. I suspect it's actually not going to be that precise as well, but it's hard to say. And now there's this last question on the native token staking, right?
Yeah, right.
Because you could have there is, I kind of need to think about it a little bit more. I would say that there's a world where you could have maybe you could kick the intersubjective slashing to the native token only, and then, use that instead of Eigen, and then have, restaked ETH just get you that big number for like a objective and attributable sort of slashing, right? I think the challenge there is that it's still not as abundant as Eigen is going to be among this supply side of operators and stakers, right? Not everybody's going to hold your native token. You're going to have to go it's going to, like a Cosmos chain, you have to get investors, et cetera, et cetera. And two, it's not custom built really to handle these intersubjective sort of slashing events.
Right.
And there's, a world where like native tokens that would have to fork maybe to actually resolve some of these really, really messy, like tyranny of the majority slashing events. That's actually not great because they have that token used in DeFi as well. And that kind of goes back to that original issue. Whereas, this Eigen token is like custom built to be able to handle those sort of forks, right? Without disturbing liquid Eigen, which is, being used in DeFi. And so I would say that it could have these like staking sort of systems, right? Where you get like really the majority of your security.
It just feels complicated.
Well, how about this? How about this though? Like you could pay for security, right? With emissions to Eigen stakers and to ETH stakers. And you could send protocol revenue to native token stakers. And then as your protocol grows over time, you could make, these could also be like two different consensus sets.
Yeah,
I agree. It seems really freaking complicated. But at the same time, it's like there is a way to do this where, it's not saying that token holders are missing out on value capture here. I think value capture of like protocol revenue is a totally separate question than what's securing your protocol. So yeah, there's a lot there. But.
Okay, so we don't really know how it's going to shake out in between what protocols are going to want more ETH or Eigen. How are the yield dynamics going to work here? And I think there are two things. Like one thing that I am at least questioning is there was always a little bit of a question of where's the yield going to come from on the ETH, because there are 50 AVSs. Eigen Layer announced 50 plus AVSs, but there's $16 billion worth of ETH. And the whole point of restaking is that the emissions are lower than they otherwise would be if you were just a Cosmos chain or whatever. So how much of that, like what is the APY going to be on the units of ETH that are getting deposited? Like not super high. And the delta there was going to be the Eigen token, as, really people were farming Eigen. But now Eigen has positioned itself as like, actually we are, the Eigen token is kind of the token that is going to be accruing some of the yield. And again, the other reason is this is bullish for Eigen is now Eigen's going to have its own return stream. But now is the role of Eigen going to be subsidizing the ETH deposits still? Like, how is that whole yield dynamic going to work?
Yeah, I agree with you. If you're saying that like we were already going to have to use Eigen to bridge the gap for ETH stakers, and now you're going to also have to use Eigen here to incentivize Eigen staking. Right. And yeah, that it could end up being a challenge. I still think it solves more problems than it causes, though. I agree. That's one of the examples it causes, or like one of the maybe like issues that's caused here. But I think people are just going to want to hold and stake Eigen as a way to basically get, this index exposure to all of these AVS rewards. And so, I think AVS emissions, airdrops, that's going to cover some portion, right? I think LRTs are going to handle a lot of these agreements in general. And I think it's still fair to like ask what the APY is going to be, though. And look at this big number and say like, well, it's just getting bigger now, right? And yeah, you need lots and lots of AVSs. And I do think that like this also just, so without Eigen again, like what other problems does this solve for Eigen longer term? It does solve kind of a monetization problem, right?
Yeah.
If Eigen was just a governance token, then the only way to actually like have value flow back to Eigen holders would have been to take a rake on those ETH payments, those payments to ETH stakers, right? And we're already saying that like, there's too many deposits, right, for the amount of like value that's going to be flowing to them. And so if you were to try to take a rake on top of that, that's a really tough, kind of overly extractive proposition. Whereas you introduce Eigen, right, and you give it like you give it a purpose that solves a protocol problem, right, and value can flow back to it for solving that problem because you take on risk as an Eigen staker. So yeah, no. Overall, I think extremely bullish.
So here's like maybe zooming out of these specifics in general is one of the reasons that I was and remain very bullish on Eigen Layer for ETH value accrual was that you're going to unlock this new yield reward stream. And I know this is kind of a heretical or sort of unpopular opinion, but the reason I think ETH is very bullish as an asset writ large is that it can do this thing that Bitcoin can't, which is earn yield. And, I understand the logical arguments that a lot of people,
because it's a work token.
Like
it's a
work token.
Productive work.
It is a productive work token, and by making it a universal work token that's productive asset, you are expanding the market share of the reward streams that ETH can accrue to it. So in a sense, this is now you're taking some of those reward streams and diverting them to the Eigen token, and I think probably it's a positive sum thing overall, because you're mitigating a lot of the risk that ETH was going to take on by earning those new reward streams. But yeah, I don't know. So I think it's probably just positive sum, actually.
I think so too. I think the risk that like ETH would have taken on, without, by, taking on both the like pretty straightforward types of slashing and the messy kinds, like would probably not be worth the, whatever the sort of like marginal rewards they get for taking the intersubjective messy stuff. At some point, it just would have been really scary, and it would have raised the cost of capital a lot for AVSs, which would have, in turn, like actually probably stymied the whole growth of this restaking ecosystem. So, yeah, I think net very positive. They are, using this token to solve, challenges that the protocol had. They're using this token to keep, the economics of the marketplace kind of really healthy and really, I guess the cost low on the supply side. And then they have, now a great excuse to basically capture value from the entire ecosystem of AVSs because the token's actually doing something critical for them. But this question of like, will every AVS adopt Eigen for intersubjective and attributable like sorts of work? I think they will, but I think it's right to question and really kind of like unpack what the trade-offs are of using this versus just using the native slashing token with restaked ETH.
Yeah, I think there is a question there. I do think maybe some protocols will opt not to do it, but overall, I think it's kind of a no-brainer. It's just rare that you see such a win-win-win. And maybe I hear myself being really positive on it. If there are alternative opinions or pushback, whatever, hit me and Myles up about it, because I would love to. I know this is still really early. This news just got unveiled a couple days ago, but yeah, when I kind of got the gist of what they were describing, it just clicked for me and made a ton of sense. So yeah, I'm supportive of it.
Yeah, exactly. Cool. I think at the end of the day, it's up to the like demand side of AVSs to decide if this is really bullish or not. But on paper, if you're Eigen Layer and you can get them to adopt it, then yeah, incredibly positive development, I think.
Yeah. So, cool.
It'll be fun to see how this plays out and how these actual like designs are set up. And if we have like a set of best practices that we kind of land on sooner rather than later. But also, maybe the last thing, I wonder what these incoming competitors are going to do now.
Me too.
Right? You've kind of unveiled now this new concept that it's going to be even more egregious if you just copy and paste this exact same concept for whatever your new restaking protocol is. Or is there a way that they're going to counter position with something that's a little bit more like, hey, you don't have to make our token integral to your security system. We're going to make it easy for you to lean on your native token at the cost of maybe value capture from our side. So yeah, pay attention to how to these competitors counter position, or if they just.
Well, I think I'm taking a leaf out of your book here. I think there's a distinction that the market doesn't fully get yet, which is the external versus native restaking. And I think there's a big opportunity for a protocol that's launching later this year, which is probably going to go with the native there are a couple angles you could do. You could really focus on the native stuff and try to adopt a large majority of ETH validators and do MEV boost things, which makes a lot of sense to me. You could I know you're not super bullish on this. I just think it really depends. You could accept multiple assets, right? Instead of just going for ETH, you do.
I am bullish on that for some reasons. Yeah, just not.
Okay, cool. Yeah, so I think there are different angles. There was an article in CoinDesk this week about how Solana restaking is taking over, and they hinted that Jito is, unconfirmed if that's true, but hinted that Jito is getting into that game, and so yeah, I think honestly, I think it's I bet we could do an update pod in 3 months. I bet restaking is going to become a crowded space because just like anything else, they're going to be copycats. And to be honest, probably people are going to lose a lot of money. I think Eigen Layer has a pretty strong first mover advantage here. But we'll see.
I agree.
Yeah.
You could counter position the axes are on the design of the protocol. You could counter position by going after a different set of use cases, as you mentioned, native versus this external restaking. Or you could counter position with different sort of economics, right? Maybe propping up the native token more so than of your customers, more so than using something like Eigen or whatever their governance token is.
Of all those, I hate the last one the most because the ultimate problem with shared security and restaking is I think you're trading, you're asking people to basically take on the equivalent of foreign exchange risk, sort of getting paid in something that is sort of low liquidity and unproven, etc., and it could go to zero type thing, as opposed to a token they actually want to hold, and which is ETH and maybe Eigen. So I don't know. I think propping that up is you're taking on even more of that risk than you otherwise would. And if it were me, I'd be taking a risk management. If I was in charge of one of these restaking protocols, I know you have to, hey, Mr. and Mrs. AVS, we're not going to dump your token, but realistically, they want to dump the token, not trying to hold these things on the balance sheet and take a bunch of token risk. So.
Yeah, exactly.
Yeah. So anyway,
lots more to come. Yep.
Yeah. Well, the other, just in ending, we're gonna pour one out for our fallen homie, CZ. I don't know if he's a fallen homie or whatever he is, but CZ's got 4 months in prison for violating KYC AML. So end of an era. But he's gonna hold on to all of his Binance shares. I can't believe he got 4. That's so crazy. It is a simulation. Simulation confirmed.
Yeah.
But yeah, I wonder if that's a little bit of a win-win because 4 months of jail sucks, but he keeps all of it. He retains his ownership. He only had to pay a $50 million fine.
Only $50 million.
I mean, he's got, he got 10 billion. It is only 50 million, or however many billions he's got.
Got a lot.
Yeah.
No, it's crazy. Yeah, I think I'm curious. It doesn't feel like Binance has been affected. So as long as Binance keeps chugging, it's kind of we'll see you in 4 months.
Yeah. I wonder, all these personalities, I do wonder how they're going to evolve. A lot of them are just going to get churned out, but I could see CZ it being like maybe like a Michael Milken sort of figure, just kind of revered. Like, I think people like Michael Milken because it seems like he was a really bright guy, very innovative in a lot of senses, but he was representative of kind of the cowboy days of Wall Street, the Wild West, LBO, junk bond takeovers that used to happen. And there's probably on Wall Street, I would guess, a heavy amount of nostalgia for those days. And, right now you and I spend a lot of time, like this Wild West kind of era, but when it's gone, I bet we're going to miss it. I think this will. Yeah. 100%.
Keeps it entertaining. It'll, it will be a lot more boring at some point, but okay.
There is no industry like it. It just moves so fast. It's so dynamic. It's so interesting.
Yeah. Go away for 6 days and come back to a whole new news feed. Yeah.
Like, does that happen in any other industry? If you left, I don't know, healthcare for 6 days, would you feel like you missed a full year of stuff?
Unless they cured cancer. No, I agree.
I've been working on that for a while.
Yeah.
All right, buddy. This was a fun one. I think we can drop it here.
Yeah, I hope we did it justice. We got more to talk about soon. We'll get more details, and good to. It was a lot of fun.
It was, buddy. It was. All right. I'll see ya.
Hey everyone, Mike here. If you're a Bell Curve listener, you know that transferring assets across chains can be a massive pain. I certainly do. I complain about it on this program all the time. That is why we're incredibly excited to have teamed up with the Wormhole Foundation, the stewards of the Wormhole protocol. And the coolest part about this particular partnership is that they have made custom Bell Curve NFTs, which you can get and mint for free. So click the link at the bottom of this episode, get your free NFT.